Everyone wants to buy stocks at the exact bottom, but nobody rings a bell when it happens. A market bottom is a zone where selling pressure quietly runs out, and the job of a private investor is not to guess the day, but to read the evidence and act with a plan that survives being wrong for a while. The hindsight trap. Alex opens his broker app in the middle of a crash. He's hunting for a signal, a headline, a chart pattern, anything that just says, "This is the bottom, buy now." He's not going to find one. Even official recession end dates get stamped on months after the fact by economists reviewing old data. By the time everyone finally agrees the worst is over, prices have usually moved 20 or 30% off the low. Bottoms only get labeled in hindsight because the market reprices the future long before the present looks any better. That's not a flaw in Alex's research, it's just how the machine works. So instead of waiting for an announcement that never comes, we're going to look for the smaller footprints that show up earlier, one layer at a time. Capitulation and panic selling. The first footprint of a bottom isn't optimism, it's exhaustion. Alex refreshes his portfolio, sees deep red everywhere, and he's not alone in that feeling. Somewhere else, a fund is dumping shares because its clients are pulling money out. Another trader just got a margin call and has to sell at whatever price the screen shows. This is capitulation, the moment when frightened and forced sellers finally give up. And here's the twist. Prices don't stop falling because buyers rush in. They stop falling because sellers physically run out of shares to unload. If Alex hits sell right here, he turns a paper loss into a real one, right when the very pressure that scared him is about to burn out. A bottom doesn't feel like a green light. It feels like everyone's just done. Extreme pessimism and sentiment. Capitulation shows up in flows. It also shows up in mood. Sentiment surveys, like the AAII poll, a weekly survey where regular investors say whether they think the market will rise or fall, measure how bearish the crowd feels. When almost everyone expects things to get worse, most of them have already sold. There's nobody left to push prices meaningfully lower. Alex scrolls through social media and sees "the market is dead" videos everywhere. His gut says, yeah, they're probably right. But extreme pessimism is a positioning clue, not a timing device. It tells you the fuel for more selling is running thin. It does not tell you to buy tomorrow. Historically, moods this dark have marked pretty good long-term entry points, just not on their own. Volatility spikes and calming. Sentiment can stay ugly for weeks. Price behavior moves faster. During a sell-off, daily swings get huge. 3, 4, 5% becomes normal. The VIX, a US index that estimates how much movement traders expect on the S&P 500 in the near term, jumps hard. Alex sees one green day up 5% and thinks, that's it, the crash is over. It usually isn't. Violent up days inside a downtrend even have a name, bear market rallies, and they basically exist to burn people who chase them. What actually signals a change of regime is the opposite, volatility calming down. When 4% days shrink into 1% days, the market has stopped pricing in constant disaster. Healthy uptrends, weirdly, are quiet, kind of boring. If the chart is still doing gymnastics, the storm hasn't passed. The bad news test. Here's where the story gets a little counterintuitive. Prices don't actually react to news. They react to the gap between news and expectations. Alex wakes up to a brutal headline: layoffs, an ugly earnings report, a rating downgrade, and braces for his ETF to gap down. Instead, it barely moves. That's the bad news test, working in real time. If the market has already priced in the worst, ugly headlines simply lose their power to push prices lower. For a private investor, this is one of the most useful clues you can watch, because it needs no special data. You just notice, quietly, when scary news stops being scary. And here's the trap. If Alex waits for the headlines themselves to turn positive, the market will already be far off the low. Price versus earnings. A lower price is not the same thing as a cheaper stock. Valuation compares the price to the earnings a company is expected to produce. So if a stock falls 30%, but analysts also cut its future earnings estimates by 30%, it isn't on sale. It's the same price tag on a shrunken product. Alex sees a favorite name down 40% and thinks discount, while underneath, the profit forecasts have quietly collapsed. That's a value trap, not a value opportunity. A real bottom shows up when earnings expectations stop falling faster than prices, when the denominator finally steadies. Price alone tells you what changed on the chart. Valuation tells you whether the business is actually cheaper than it was. Market breadth improvement. Here's an easy thing to miss. The index is not the market. Most familiar indexes are weighted by company size, so 5 or 10 giants can drag the whole line down, while hundreds of smaller stocks have already quietly stopped making new lows. Market breadth is just a count, how many stocks are participating in a move. In a bottoming zone, the headline index can still print red days, but underneath, fewer and fewer names are hitting fresh lows. Alex only watches the index, so he only sees weakness. What he's missing is that the basket underneath has stopped rotting. Breadth improves before the index does, because the market usually heals from the inside out. Higher lows confirmation. Every bottom kind of looks the same in shape. Prices fall, they bounce, and then they fall again, but the second fall stops above the first one. That's a higher low. It's the market's rough way of saying, sellers had another shot at it and they couldn't push it back down. Alex wants to catch the absolute low, and that desire is going to cost him. Waiting for a higher low means paying a premium, maybe 5–10% above the actual bottom. In return, he gets evidence instead of hope. Chasing the very lowest tick is a game where you win pennies and occasionally lose fortunes. Paying up for confirmation is how you avoid catching a falling knife. And this is also where reading the market ends and acting on the market begins. Phased buying and DCA. So the signals are lining up, imperfectly, uncertainly, the way signals always do. Now what? This is the shift from analyzing the market to running a plan that manages probability instead of trying to predict it. Instead of betting everything on one perfect day, Alex splits his investable cash into tranches, maybe 30% today, 30% in a month, and the rest kept in reserve if things get worse. This is dollar cost averaging. What it really does is turn an impossible question, where's the bottom, into a manageable one. Am I building a position at reasonable prices across time? If the market drops after his first buy, tranche 2 gets a better price. If it rips higher, at least he already owns some. DCA doesn't guarantee a low average price. What it guarantees is that a single wrong guess can't wreck him. Portfolio rebalancing. There's a quieter version of the same discipline for people who already hold a portfolio. If Alex targets 60% stocks and 40% bonds, a crash tilts that mix. Maybe now it's 50-50. Rebalancing just means selling some of what held up and buying more of what fell to restore the original weights. No forecast, no headline reading. The math itself forces him to buy stocks at the exact moment his emotions are screaming to do the opposite. This is the practical answer to when do I buy? You buy when your plan is out of balance. And the most reliable bottom signal in your investing life doesn't show up on a chart. It's the gap between the allocation you're holding today and the one you committed to before the fear ever started.